Hi, welcome to this monthly update video. We'll be talking about the past month's biggest news stories, including the increase of inflation, the recent conflict in Iran, and some key points from a recent investment conference, and how all this has an overarching effect on investment markets. As always, these videos are general in nature and designed for my clients, family, and friends. Should you wish to talk directly about your situation, please do not hesitate to contact me. Right, so we'll start with interest rates. In February, the Reserve Bank of Australia lifted the official cash rate by 0.25% to 3.85%, marking our first rate rise in over 2 years as inflation stubbornly stayed above the RBA's comfort zone. While prices had been climbing here at home, it's not just local factors at play. Government spending, global events like the ongoing conflict in Iran have pushed up oil and energy costs, which flow straight into everyday bills and add to the inflation challenge. Those rising costs make it harder for inflation to cool, so even though the RBA has said it's too early to know exactly how the war will play out, the risk of sustained price pressures means further rate hikes can't be ruled out if prices stay elevated. The recent investment conference I attended believes that the Australian RBA rate could increase to as high as 4.25% over the next 12 months, meaning a further 2 to 3 rate hikes in total across the market. In more recent news, we have seen the recent conflict between Iran and the US have impacts on the investment markets. When we look back at wars previously, the month leading up to the conflict, you often see a lot of volatility, which we had seen since the start of the calendar year. Then when war breaks out, the share markets usually react pretty quickly. The first few days or weeks are often driven by fear and uncertainty. Investors don't know yet how big the conflict will become, how long it will last, and what it might mean for the global economy. So markets tend to fall initially. Although we have seen Australian market drop, the US is holding fairly resilient so far. We saw this during the Russian invasion of Ukraine, when markets dropped sharply in the early stages. A similar pattern happened during the Gulf War. That early reaction is usually emotional and uncertainty driven, rather than based on long-term fundamentals. But here's the interesting part. Markets don't like uncertainty, and once there's more clarity, even if the news isn't great, they often begin to stabilize. Investors start assessing the real economic impact rather than assuming the worst. And historically, many markets have recovered within months of a conflict starting. And if we look 6 to 12 months down the track, history shows that markets are often actually higher than where the war started. That's because share markets are forward-looking, they're focused on companies' earnings, economic growth, interest rates, and inflation, not just the headlines. Of course, every situation is different. If a war leads to prolonged energy shocks, higher inflation, or aggressive interest rate rises, markets can remain volatile for longer. But broadly speaking, the pattern we've seen over time is an initial dip followed by stabilization and often recovery within a year. The key message for long-term investors is this: short-term volatility is uncomfortable, but reacting emotionally to global events has historically hurt returns more than helped them. Staying disciplined and focused on your long-term strategy has generally proven to be the better approach. Now I want to do a bit of a recap of the investment conference I recently attended. So where we heard from a range of experts across different specialities, all sharing their outlook for the next 12 months. Overall, the message was fairly constructive. Markets are looking relatively healthy. That said, they did highlight what they see as one of the biggest risks right now, which is the labour market, particularly job openings. A lot of businesses are becoming more efficient through the use of AI. And in some cases, that's led to layoffs, which we've seen in recent news. What's interesting though is that many companies aren't rushing to rehire. They're waiting to see where new opportunities emerge and how AI reshape their workforce needs. If job openings slow too much, that can eventually impact consumer spending and broader economic growth, which markets pay close attention to. Now, another question I often get is around the cost of implementing AI, which was discussed in detail at the conference. One key takeaway was that many large companies are actually funding their AI infrastructure with existing cash reserves rather than taking on large amounts of new debt. That's very important because it means if the AI investment cycle doesn't deliver the returns some are expecting, these businesses aren't left servicing significant debt burdens. The trade-off, of course, is that if those cash stockpiles are heavily used, it could slow future investment activity until balance sheets rebuild. But overall, it does reduce financial risk in the system. So in summary, markets look reasonably healthy, but employment trends and how successfully companies execute on AI investments will be key themes to watch over the next year. As always, if you have any questions or concerns regarding this video or your personal situation, please do not hesitate to contact me at any point. As always, your financial well-being is our #1 priority. Thank you.